As of lately, the stock market has gone up and down quite a bit, and some stocks more than others. This will create great buying opportunities. And especially for you, I find 4 stocks that I'm buying in 2025. 3 of them are already in my portfolio, and I'm literally bought more yesterday. So without further ado, let's dive into these stocks and do a quick analysis. First on the list is VICI Properties, ticker symbol VICI. This stock is all over YouTube right now, and many investors are talking about this particular stock. And the main reason is because VICI is down 15% from their year-to-date high, making VICI a 30 billion market cap company. And since this is a REIT, it's not fair to use the PE ratio, so we're using the price to FFO here, which is sitting at 10.8, insanely low for a high quality REIT like VICI. Revenue is increasing really steady and consistent, but it has to be said that it is slowing down a bit lately. Margins are increasing as well, which is a great sign to me. And to make things even better from here, Fiji has a dividend yield hovering around 6%, and payout ratio is at only 64%. The growth numbers are also looking pretty good if you ask me. It is a REIT, so we have to take that into account. For the price targets, we have to fill in the 3 assumptions based on a high, mid, low scenario. I put in quite conservative numbers, and it turns out that Fiji is currently sitting a little above the low price target. And in my opinion, the mid price target is the most accurate here. So that means that Fiji is undervalued right now. Down the line, I think Fiji is a great buy at current prices. And that is exactly what I'm doing right now. Next on the list is the famous monthly dividend paying company. And I know I have been talking a lot about Realty income lately, but it is looking really good in terms of stock price right now. This stock went down around 17% as of lately, sitting around $53. And most big investors start buying around $50 again. So we're almost there. Realty Income is a 46 billion market cap company. And again, since this is a REIT, I'm using the price to FFO to see the valuation instead of the PE ratio. And currently this number is sitting around 13, indicating they are undervalued. Revenue is increasing really steady and consistent, so that is looking really good. And I know people are talking about some tenants that are struggling, so that's something to keep our eye on, of course. Personally, I don't see this as a major issue, but of course we should evaluate this from time to time. Margins are going down over a longer period of time, which is of course something that I don't like. Probably this is one of the only few things that I don't like about Realty Income. But take a look at these dividends, a 6% dividend yield, monthly payouts, healthy payout ratio, and even a decent growth rate for a REIT. And on top of all of this, 26 consecutive years of dividend increases. To me, this looks really good. For the price target, we have to fill in 3 assumptions, based on a high, mid, low scenario. And since this is a REIT, we only focus on the discounted cash flow value. And then it turns out that Realty Income is also hovering around the low price target. And remember what I said about the $50 mark? That's when most bigger investors are buying. And to me, the mid price target is again the most justified here. So it looks undervalued to me. And that is also the reason why I bought big time not too long ago. And probably in the coming weeks I'll be buying even more. And next up we have a stock making its debut on the channel, Old Dominion Freight, ticker symbol ODFL. This stock came onto my radar after several investors brought it up on YouTube. So here is my take on Old Dominion stock. The stock went down 20% most recently, which is really interesting. On the year-to-date chart, the stock is down 10%, creating lots of buying opportunities. And Old Dominion is a 38 billion market cap company, and PE ratio is at 30, which is a bit on the higher side to be honest, but hear me out. Revenue is increasing in the long run, And most recently, they are finding some momentum to increase the revenue again after a short period of struggling with the growth. And now the part why I love this stock so much. The margins are increasing drastically for this company over a longer period of time. And yes, most recently it is kinda stabilizing. But still, the long run looks really good to me. And that is also reflected in the dividend scorecard. We are starting with a low dividend yield of only 0.6%. But take a look at the payout ratio and those growth stats. They increased the dividends at a really high pace in the recent years. And still, payout ratio is at only 17%. To me, this looks really good. A great compounder for the long run. And now the tricky part, the valuation. Earlier we saw that we need to pay a premium for the stock, even after it went down 20% most recently in stock price. So let's fill in the three assumptions and see where this stock is at. Since margins are increasing drastically, and I also expect that in the coming years this will be the trend, I'm willing to pay a premium for the stock. But even with some premium numbers, we see that only the high side of the high price target is indicating that this stock is a buy. So this means that in order to become an interesting value play, the stock needs to drop another 10% from here. But since I really like the company, I'm putting them on my watch list and wait for a pullback, since I just really like this company. And now we have come to the last stock on this list, Stag Industrial, another favorite read of mine. And this one is in the buying range. This REIT is down 17% from the year-to-date high, similar to most other REITs. And Stag Industrial is a 6 billion market cap company. And since this is a REIT, I'm using the price to FFO instead of the PE ratio. And this number is sitting a little under 14, indicating Stag is undervalued. Revenue is increasing really steady and consistent over the years. To me, this looks really impressive, especially for a REIT. Margins are increasing in the long run, which is really great. Most recently, margins are going down a little bit, so that's something to keep our eye on. The dividend yield is hovering around 4.4%, which is a great number. And keep in mind that Stag Industrial pays a monthly dividend instead of a quarterly dividend. The growth rate is barely there, but they increased the dividends 11 years in a row. This company is just rock solid and steady and consistent. For the price targets, I'm filling in the three assumptions. And currently, Stag Industrial is hovering around $33 to $34, which is slightly higher than the low price target. And for me, the mid price target is the most justified here. So that means that Stag Industrial is undervalued based on these numbers. And I'm currently planning to buy Stag Industrial by the end of this month. It's a great time to DCA a little bit, and this company is performing really steady over the years. And these are the four stocks that I'm currently keeping a close eye on. And as a matter of fact, I recently bought Realty Income and VICI Properties, and Stag Industrial is on the list. And I can't wait to pull the trigger on Old Dominion. Which stocks are you currently buying? Let me know in the comments down below. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.